just so you know, it doesn't matter what your financial advisor dresses like. It's what matters is what's in his head and his experience. And for many of you, I'll wait for a few more hundred to come in, and then I'll tell you a little bit about me. For many of you who don't know me, I know we've made thousands and thousands of new followers. Many of you don't know me, so I'll talk to you a little bit about who I am and why I'm doing what I do, why I'm trying to help you, and then we'll go from there. But today we have a topic which is one of the most understated topics that you can ever imagine. Nobody ever talks about it. People talk about all kinds of things. They talk about stocks, they talk about Bitcoin, they talk about gold, they talk about emerging markets in Europe, they talk about real estate. Very few people ever talk about bonds, and so that's what we're going to do today. We're going to talk about bonds, and it's interesting because bonds could be a very, very interesting part of your portfolio. So anyway, a little bit about me. Well, I'm David Adefeso. I think it's about 7 minutes, in, so we'll start talking. I'm David Adefeso. As you know, I came from Nigeria 30 years ago. I'm an old guy now. Hopped on an airplane, landed in JFK, got to LA, went to Harvard Business School, worked for a number of years as an investment banker, buying and selling billion-dollar companies, raising money for billion-dollar companies, and then set up my own practice as an investment advisor. And we grew, our New York office, Woodland Hills office, Texas office, Fort Worth office, downtown LA, we grew. And now I'm bringing you some of the knowledge that I've learned over the last 30 years, some of the things that I've seen some of the wealthiest people in the world do. I'm showing it to you because I believe that the system is built to support the prosperity of the 1%. I mean, think about it. There's a curve. Life is a curve. By default, somebody has to be the 1% and somebody has to be the 99%. The only question is, who is that? Is that you or is that your neighbor? And I think it could be you. I think you can be one of the 99. If I was able to do it from nothing, I came into the US with $250. And now, God willing, I've prospered. I was blessed, but I also did certain things I didn't even know I was doing along the way. And many of those things I'm going to bring to you today and going forward. And I brought to you before. And some other things I'm going to teach you about what I do for many of the wealthy people I work with. And I'm going to show you how to maybe rise from where you are and become one of the 1%. And so I've talked to you about a lot of things. I've talked to you about stocks. I've talked to you about things to do during the recession, things to do during COVID-19, ways to reduce your expenses, ways to reduce your income. I've talked to you about sleep money. I've talked to you about protecting your assets, talked to you about trust. I've talked to you about a lot of things. I got to tell you, some of the things I'm teaching you, you'd have to go pay an estate planning attorney, $600 or $700 an hour, or a financial planner, $400 or $500 an hour to learn some of those things I'm teaching you. So you don't need to do that. You can ask me questions. Hi, Tina, I see you. Yes, the technical team, they're amazing guys over here. They're doing a great job. And so I'm bringing you some of those things that can help you rise from where you are, the 99%, if you're there. And even if you're one of the 1%, I work with many people like you. I can show you alternative ways for you to increase your wealth, protect your assets, or reduce your expenses. So let's jump in. Today we're going to talk about, last week we talked about stocks. I broke stocks down for you. What are they? How they work, where to buy them, how to pick, stocks. I gave you two amazing ways: the price earnings ratio versus the growth rate, and the dividend yield now versus historical dividend yields. And I drew for the first time on a chalkboard. So I figured, I'd keep a chalkboard over here. If it's useful and I can use it, maybe I will. If not, maybe I won't. But it's kind of cool to have it over here. Today, we're going to talk about something a lot of people have called the opposite of stocks, which is bonds. What is a bond? A bond is an instrument. It's an investment product that you buy. But what is a bond? What is the essence of a bond? A bond is simply a loan that you give to a company or a person or a government It's usually a corporation, a company, and a government. And you give them, $1,000, for example, and they promise, look, we'll give you, or you give them $100. Let's make it easy. You give them $100. They promise, I'll give you $10 every year, 10% for the next 10 years. And after 10 years, so I'll give you $10, I'll give you $10, I'll give you $10 every year for 10 years. But then after 10 years, I'll give you back your $100. It's easy, right? You give money, they give you interest, they take that $100, they go invest it somewhere where they can make more than 10%. You don't know, you don't care, you don't want to know. Let them do what they do, as long as you get your 10%. But a bond is, so that's the essence of a bond. It's an investment that you buy, which pretty much is you giving a loan to some entity, like a government, and they promise in return they will pay you a certain amount of interest per year. And at the end of the term, there are a lot of things I'm dropping that are going to be useful. And we're going to talk about those things like term. At the end of the term, they will give you back your money. That's the crux of a bond. And so there are a couple of things you should be aware that I just told you. One, it's a loan. You're giving a loan. So it's relatively secure, right? Maybe not so much. We'll talk about that too, the risks involved in bonds. And so we'll talk about what are the risks involved in bonds. We'll talk about how to value a bond. We'll talk about different types of quality of bonds. We'll talk about the best place to buy a bond. We'll talk about whether or not you should be buying a bond now. Many people ask me, they're like, should I buy stocks? I'm like, yes, because they're still a good investment because you're betting on American companies. They said, should I buy bonds? I'm like, wait, maybe, maybe not. It depends. Now, keep in mind, I'm not giving investment advice here. I'm an investment advisor. I'm registered but we don't, investment advice is something that's very specific to an individual or to a corporation. And so for you to get the best investment advice, you need to be working with someone or an entity that knows your circumstances, whether that's me or somebody else. We're not taking new clients now, maybe for over the next month or so, we're really busy. But there's a lot of advisors out there that you can work with one-on-one, or you can go online. But don't, anything you hear, go do some, from me, go do some research or talk to your investment advisor or your CPA or someone else. So it's not intended to be investment advice. It's also not intended to be tax advice. And it's not something that you should, go bank on the tax, go start taking, listen, learn, and then go consult with your CPA or go do some research online or go consult with your financial advisor. So keep that in mind. Okay, so I just told you a few things. A bond is a loan you give to a company or a government, and a bond is pretty much something that is you're guaranteed, or you're given interest every year. So you get it's a term. There's a price. There's an interest rate that you receive, and that's pretty much the essence of a bond. Now, what are the different types of bonds? I just told you it's an interest rate that you receive every year. Well, not necessarily. Yes, it's interest you receive every year, but that interest may not be fixed. It may not just be they're going to give you 10%. Now, 10% is just a number I threw out, right? It could be 2%, it could be 3%, it could be 5%, but it's a number that they give you every so often. And that number could be a fixed amount, like 5 or 10%, or it could be a number that is based on something else. For example, LIBOR or prime or some other benchmark. I'll give you an example. Let's say you go buy a 30-year mortgage. You go get a 30-year mortgage, right? You're paying full 5%. You get the mortgage, 5%, and you got to pay 5% every year on the mortgage, interest. But what if you decide to go refinance your home and get a home equity line of credit? The interest rate you pay is not usually 5%. It's a certain number, like 2 or 3%, plus another number, usually what's called the prime rate. The prime rate is the rate that the best quality corporate companies get to borrow at. That's, it ranges, depending on what the Federal Reserve fund rates is. Right now, I think it's about 3.25%. So the prime rate plus a certain number. So a bond is not just something, there's a type of bond that gives you a fixed amount every year. There's also a type of bond that gives you interest rate that is variable every year. Sometimes it's tied to an index. They're called floating rate bonds, not fixed rate bonds. The first one is fixed rate bonds. The second one is floating rate bonds, the bonds that the interest rate goes up and down based upon what another interest rate is doing. And then there's the third type of bond. So one is the fixed bond, fixed interest rate. One is the variable. The third type of bond is one that's called a zero coupon bond. That's the one where you don't even get cash interest rate at all. They don't even give you an interest rate right now, right? You buy the bond at a discount. So let's say a bond is $100, right? I want you to borrow me $100, but I don't want to give you interest every year for 10 years. Why don't you just pay me $75 now? And I'll give you $100 in 10 years. What I've done is, instead of paying you 10% interest every year, I've imputed that interest into the cost of the bond now. So I'm giving you the bond at a discount. So those are called zero coupon bonds. That's the third type of bond. One is a fixed rate bond. One is a floating rate bond. One is a zero coupon bond. Okay, am I confusing you now? Bonds are actually very complex things. They're some of the most complex investments you can find out there. But there are also some of the investments that are very, very useful in helping you diversify your portfolio. Let me stop for a second and tell you the uses of a bond. If you buy a stock, right? A stock is an ownership interest in a company. So you own a stock, right? You buy a stock of, say, Apple. I'm not recommending Apple. I'm just using it as an example. So you buy a stock of Apple, one stock of Apple. Apple could go up or down, like I told you last week, based upon the profits. Well, Apple goes up and down and up and down and up and down. What if you don't like that? What if you don't want that up and down, up and down, up and down? To reduce the what you call volatility, that's the aggressive up and down in stocks, you could buy a bond. Remember what I just told you about a bond, especially fixed rate bonds. You buy a bond for $100, it gives you 10% interest every year, $10 every year, fixed. You're guaranteed to get your 10% unless the company goes bankrupt. We'll come to that in a second. That's the credit risk, right? So unless the company goes bankrupt, you're going to get your 10% every year. So you're confident in buying Apple, going up and down, and buying a bond that's fixed. And so when you add both of them together, it stabilizes your portfolio. So instead of doing this like a stock or doing this like a bond, it does something like this. And so let me draw it out for you. So typically, here's what a stock does, right? That's a stock. And then, especially a fixed rate bond, here's kind of what it does. And then you get your principal back. There's a fixed rate bond. When you buy a stock and a bond together, you get something like this. Hopefully it's going in the right direction. Up, with the right investments, it goes, from bottom left to upper right-hand corner. So this is the stock plus bond phenomenon. That's why you buy a bond, in order to stabilize your portfolio. Now, does a bond actually really do this? Well, we'll talk about it in a second. But then let's talk about the different types of bonds that they are. I just said a bond is something you could borrow a company, or you could borrow a government, right? And those are really the two different types of bonds. And well, there's two, but it's really three. The government is divided into two. So there's corporate bonds. That's the bond. So you give Apple $1,000. Apple says, you know what? I'll give you 2% every year. And so you're going to get you get your $20 every year you put in your pocket. At the end of 10 years or 5 years, you get your $1,000 back. That's a fixed rate bond. That's a corporate bond. On the other hand, you can buy what you call a Treasury bond. A Treasury bond is a bond that you're loaning money to the US government, the federal government. So all these things, the stimulus package and the $1.5 trillion they gave us for COVID-19 and the $480 billion they added to it and all that money they're giving us. Where does the government get the money? Where does the US government, we got a big deficit. We have over $1 trillion in budget deficits every year. Where does the US government get extra cash? We make about, we spend about $22 trillion every year. And we take in about 20 or $21 trillion. Where does the extra $1 trillion come in? Well, it comes in because we go borrow. The federal government, the US Treasury, issues debt. And that's called a Treasury bond. That's bonds you buy, right? And so that's the second type of bond. That's the Treasury bond, the second issuer. The third type is a municipal bond. What's a municipal bond? A municipal bond is a bond it's a loan you give to a county or a municipal institution like LA County, Los Angeles County, or New York State, or Tarrant County in Texas, or Orange County, or California. Not the federal government, but to a state or a municipality. That's the third type of bond. Now, what are the differences? Treasury bonds, that's the US government bonds, are considered risk-free. You have no risk. The US government will give you back your money. Is that true? Well, technically it's true. But practically, well, we don't know yet. We got to live through this, the next 50 or 100 years of borrowing and borrowing and borrowing and borrowing to see if the US government will actually give you your money back. But in essence, it's considered risk-free, which means no risk. Why? Because we have this thing called the taxing power. So if the US government feels like it can't repay its bond because it doesn't have enough cash, guess what it's going to do? It's going to raise your taxes. I'm not using that as a threat. It's just the way it works. They just raise taxes and they get more money from you to pay off the bond. That's kind of how it works. So that's considered risk-free. The second type of bond in terms of security is the municipal bonds. And those are bonds you give to counties. They're considered relatively safe because most counties don't go bankrupt. You've heard of Orange County, you've heard of Hawaii, you heard of Chicago getting close, Detroit. That's an anomaly. Most counties and municipalities are pretty secure. And then there's a third type called corporate bonds. Corporate bonds in general are divided into two. There's what you call investment grade bonds. And there's what you call, junk bonds. There's investment grade bonds and there's junk bonds. These are usually corporate bonds. That's loans you give to corporations. Now, imagine you give a loan to Apple, right? And Apple says, you know what, you give Apple $1,000 and Apple says, I'll give you your money back in 10 years. In the meantime, I'll give you something every year. Let's call that 2% every year. I'll give you 2% every year. Cool. So you get your $20 put in your pocket, $20 put in your pocket, and every year, Apple, and then after 10 years, Apple gives you your money back. What if you wanted to loan money to the guy the dry cleaner next door? That guy who, is a nice guy. He has one store. He's busy. He's doing well. He wants to expand another location. So comes to you and says, David, would you give me $1,000? Give me a $1,000 loan, and I will give you interest back every year. You think, oh boy, that dry cleaner could go bankrupt. Now, Apple could go bankrupt technically, but the chances are very slim because it's a very big company and it has a lot of cash flow. That's the key, cash flow. That dry cleaner is a small company and he's going to be using up his cash flow to open up a new business. If a recession hits, he might go bankrupt. So that dry cleaner, who you may decide to loan money to, is a higher risk than Apple. He or she would be considered junk bonds. What junk bonds are is there's a higher chance than normal that they go bankrupt. For the investment grade bonds, the strong ones, there's a higher chance that they do not go bankrupt. And so for people who are looking for better security, stronger security, who are looking to almost make sure, because it's nothing sure in life except death and Uncle Sam taxes. But if you want to be relatively sure that you get your money back, you want to buy investment grade bonds. Those are bonds, Standard & Poor's, that's a credit rating agency, rates above, I'd say BBB- and above. That's called the investment grade bonds. Junk bonds, on the other hand, lower than triple B minus, so double B plus and below. And so go back to that example of the dry cleaner, right? So the guy, now I'm going to give him $1,000. Am I going to charge him 2% like I charged Apple? I don't think so, because he might go bankrupt. And if he goes bankrupt, I lose my $1,000, or at least a portion of it. So the risk I'm taking is higher. So I'm going to charge him a higher interest rate. So instead of 2% that I charge Apple, I'm happy with that $20 Apple is paying me. I may not be happy with that 2%, with that dry cleaner. I may charge him more like, I don't know, 8%, maybe 10%, maybe 12%, maybe even 15%. Apple will never pay me 15%. It doesn't need to. You just go raise more stock. It can borrow cheap, or it can go to a bank and get bank debt. But most people, but that dry cleaner could pay me 15% or 12% or 10% or something like that, a lot higher. So typically, junk bonds, or what we call non-investment grade bonds, are bonds that will give you a higher interest rate. So now you're getting I think I'm a little crooked over here. Let's see if I can get this back on track. Okay, so junk bonds in general, or non-investment grade bonds, would typically give you a higher interest rate. So if you need money, if you need, you're trying to grow your assets fast, and you need more cash flow, you're ready to take more risk, it's okay to buy some of those junk bonds, at least until but make sure to do your research. If you're good, you're happy, you don't need to make a lot more money, you just want to maintain what you got, make a little bit of principal, and hedge your stocks, like I just showed you, then you want to go with investment grade bonds. They give you less interest rate, but they're more secure. And that's where you get to this thing called credit risk. Now, I just told you about security and not security, and how you may get your money back with a dry cleaner, you may not, you get your money back with Apple. So, and I just talked about how bonds are relatively safe compared to stocks. And the question then is, David, you just said I could lose my money. A bond is a bond, right? Investment grade on investment. If I give my money to that guy, I may lose my money. But you also told me that bonds are relatively safe. Which one is it? So bonds in general, my friends, have this thing called risk. Many people buy a bond thinking, oh, there's no risk, I'm going to get my money back. Bond has a significant amount of risks, but those risks are sometimes different than the risks of stocks. Sometimes they're the same, but at the same time, there are some risks that like credit risks. There's some risks that you may not know about, like duration or reinvestment risk. So let's talk about the risks of a bond. When you decide to go buy a bond, open up your 401k tomorrow, right? And look at your investments. You may have something called a target date fund. If you have a target, by the way, that's what we're going to talk about next week, retirement accounts. I get you excited, right? IRAs, 401ks, all those wonderful things. We're going to talk about those things in a little bit. And so just make sure to subscribe. If you look if you're watching me on YouTube and you see the red button, red is bad. You don't want red, you want gray. So make sure to subscribe so I can alert you about the things that I'm about to talk about. Next week is going to be about retirement accounts, 401ks, IRAs. It's going to be about profit sharing plans, defined benefit pension plans. Should you do them? Should you not do them? What are the differences with the tax benefits, with the asset protection benefits? Why would you not do a 401k? There are reasons why you may not want to do a 401k. But in general, you should. I break it down for you. I do those things. I market those things. I actually have, one for my company, and I have one that I've done, a lot over the years for many of our companies. So I'll break it all down for you, and I'll show you the benefits of retirement accounts. Today, we're talking about something that you very likely have in your 401k, and maybe you don't even know it. 70% of people or so have this thing called target date funds in their 401ks, right? If you go to a target date fund, click on that button, whether it's with Schwab or with Fidelity or with Vanguard or whoever you're with. Click on that fund and go into the investments. Inside of those target date funds, you have stocks and you also have bonds. So you may have bonds that you didn't even pick that you actually have. Those bonds have risk. What are the risks that are in bonds? Well, one of them is, the biggest one is called credit risk. What is credit risk? Very simple. Credit risk is the risk that your bond, that company who you loaned money to goes bankrupt. Yikes. Imagine a situation, you work real hard, you go to work every day, 9 to 5, 96, 97, sometimes you work overtime, you take the money you got and you invest it in a bond, hoping to make a little bit of principal every year so you can feed your family and you can retire, send your kids to college one day, and that bond just disappears. The company goes bankrupt and you lose all your money. It hurts a lot. So when you pick a bond, be careful about what you call credit risk. That is the risk that the company goes bankrupt. How do you prevent against credit risk? You do your homework. You want to make sure the company has enough liquidity, which means the company has enough cash to meet its bond liability and its other liabilities. I'll give you an example. Imagine you go to work every day, you make $60,000, right? That year you make $60,000. What happens if you spend $80,000, right? You like good things, you like nice restaurants, you like you take like nice Uber rides, you take the Uber SUV, you don't take the Uber economy, right? You take all the expensive, you like the expensive stuff, so you spend $80,000. I'm not saying people who make 80,000 have like expensive habits. I'm just using it as an example. So you're spending more than you're taking in. What happens? Well, you have to borrow the $20,000, right? The difference between what you make 60 and what you spend. Over a period of time, you keep borrowing, you can make 60, you spend 80. After a few years, you don't have enough money to you go to your bank and your bank says, I'm not giving you any more money. Then you go bankrupt. You have to file for bankruptcy. The same thing happens to companies. When a company makes money, but it's spending a lot more than it's making, that company would typically go bankrupt. And so you want to be careful about those companies. Just to make sure you do your research, you're buying companies that have enough cash flows to meet their obligations, including their debt. The second type of risk is interest rate risk, right? When stocks go up, when interest rates go up, bond prices go down, and the opposite happens. Now, it's a very interesting relationship. Let me give you an example of how that works. So let's say you own a bond. Let's use that very simple example. You buy a bond, for $100, and they promise to give you 10% interest every year. 10. I don't know where you're going to get that now. Interest rates are very low. You're never going to get 10% unless you go buy some deep junk bond, but I'm just using it as an example. So you buy a $100 bond and you make 10%. That's $10 a year. You're happy. You got 10 years to get your money back. $10 is pretty good. What happens when interest rate drops to 5%? Wow, your bond that you bought for $100 is paying you 10%. Now, other bonds are getting issued, and those bonds are giving people interest rate of 5%. The same type of bond, same company, 5% interest rate. I'm getting 10%. They're getting 5% for the same bond, same maturity. Is my bond more valuable than that bond or less valuable? Of course, my bond is more valuable. But that's the new bonds that are being issued. So whenever that interest rate drops, the buy bond price goes up. My 10% bond is more valuable when the 5% bond gets issued, because by default, I'm making more interest than they are. So in general, when interest rates drop, like they have over the last 3 months, 2 months, with the Federal Reserve, with COVID-19, when interest rates drop, bond prices go up. On the other hand, the opposite happens. So let's go back to my example of 10% bond, 10% interest, right? I have a $100 bond, I'm making 10% interest. Interest rates now go up to 15%. The next bond that's issued, they're getting 15%. Whoa, that's more than my 10%. I'm only making 10%. the kids next door are making 15% on the new bonds that are being issued. Is my bond at 10% more valuable or less valuable than that bond that's giving me 15%? It's less valuable, right? And so what happens is my bond now will go down in value. Why? Because it's 15%. Who wants that, excuse my friend, that shitty 10% bond? Nobody wants that shitty 10% bond. Everybody wants the nice new 15% bond. So my bond goes down in value. So the next relationship is when interest rates go up, bond prices typically go down. So please keep that in mind today, because what we have today is interest rates that are very, very low. We went through a very difficult time. We're still going through a very difficult time in America. I've been in America for 30 years, since I was 21 years old. I'm going to be 51 in November. I look young, right? I know, but I'm just kidding. I've been through a lot of recessions since that time. I've always worked in finance, whether it was as an accountant or whether it was on Wall Street, working with billion-dollar companies, or now working with multimillionaires and billionaires individuals. I've always been in finance, apart from when I was at Harvard Business School, and then I was doing finance as management as a major. But I have never seen a time like this before. I've never seen the stock market crash so hard, so fast. And I went through 1987. I was in school. I wasn't here yet, but I was in school and we were watching it. But it came right back. I have never seen the stock market crash so fast and then come back so hard. It was down to 30, 35%, come back so hard. It was a lot going on. And so a lot of people are hurting. And a lot of people lost jobs. It's over 30 million people lost jobs. And the Federal Reserve, the government, to help those people, to help us, to help me, to help you, decided to do a lot of things. They gave us money up to $1,300. They gave us a PPP, a Paycheck Protection Plan, EIDL, Economic Injury Disaster Loan. There's a lot of different loans and programs, unemployment insurance that they did. But also, one of the things the government did, the Federal Reserve, is reduce interest rates. They took what you call the Fed funds rate, and I won't spend too much time on that, the Fed funds rate or the discount rate. They took the federal funds rate, the rate the Federal Reserve gives money, overnight loans the rate banks borrow each other money overnight is the Fed funds rate. They dropped it to zero. Every other note, mortgages dropped, bond yields dropped, everything dropped when it came to interest rate. What did I just tell you happens when interest rates drop? Bond prices go up. So what has happened over the last 3 months or so is that the benchmark, which is treasuries, there's about $40 trillion in bonds. It's interesting. People ask me, what's the total value of bonds versus the total value of stocks? I'm sure stocks are more. No, there's more bonds out there. There's a little over $40 trillion in bonds. There's under $39 trillion in the stock market as of about a few months ago. And so bonds are bigger. Of that, 14.5 trillion is US Treasury bonds. That's usually the benchmark. When treasuries drop, remember what I told you about floating rate bonds tied to a benchmark? Usually a lot of those bonds are tied to the 10-year treasury. The 10-year treasury is about 0.65%. Normally it's like 5%. It dropped all the way from 5% all the way to 0.675% roughly today. Guess what's happened to the price of the bond? It's gone all the way up. So the question you ask me now is, should I buy a bond? I tell you, well, maybe, maybe not. Because bonds are very expensive, relatively expensive right now, because the price of those bonds have dropped. They've dropped significantly. Sorry, the yield of those bonds have dropped. That's the interest rate, and the price has gone up. So if you want to buy a bond now, you want to be very careful. If you buy a US Treasury bond, I'll give you an example. If you buy a US Treasury bond, a 10-year bond now, today, you want security and you want safety, right? You buy a 10-year bond, you give the US government $1,000. And they tell you, we're going to pay you 0.675 every year for the next 10 years. Okay. That's what, $6.75, something like that, whatever. All right, cool. I can roll with that, Anyway, so the government decides we're going to pay you, pretty much something that is so small. Let me tell you what the impact of that is. There's this thing called inflation. Inflation is the increase in the cost of goods and services every year, right? Goods and services, everything you buy. You buy a piece of, you buy a house this year, next year is more expensive, right? And the year after is usually more expensive in general. You buy, equipment, you buy toothpaste. The chances are it's more expensive in 3 years than it is today. So the cost of the things you're buying are going up every year. So you need your money to be growing around the same rate or higher than inflation. On average, inflation in the US, it's low now because things aren't going up, they're actually going down. But in general, it's usually around 3%. So if the cost of the things you're buying every year are growing by 3%, you take your money and you give it to the US Treasury, the US government, and they pay you less than 1%. Your investment is growing by less than 1%. Your cost, that's the things you're going to be buying, are growing by 3%. Does that make any sense? So to answer your question back, I'll let you answer the question. If your expenses are growing by 3% and your income is growing by 1%, does that make any sense? Not really. Maybe you should be looking for things that would pay you more than 3%. What are those? I like stocks a lot. Again, this is not a recommendation. I'm not saying you shouldn't buy bonds. I'm not saying you should buy stocks. But if you have at least 5 to 7 years, you should definitely be looking at stocks. 5 to 7 years before you retire or you use the money, you should definitely be looking at stocks. If you have less than 5 to 7 years, you may want to be careful about looking at bonds. The only time you should really buy a bond now is when it's a part of a diversified long-term portfolio. And I'll give you an example. Let's say you're 45 years old. You want to retire at 65. That's 20 years. You're not a stock or a bond market guru. You don't go around, buying stocks and bonds and picking investments. You just want to keep your money in that 401k, close your eyes and wake up in 10 or 20 years and look at it. That's the one situation when you want to buy a bond. Because the bond, like I said, can help stabilize an otherwise volatile portfolio. So, but if buying a bond now to sell it for 2, 3, 4, 5 years doesn't really make a lot of sense. Anyway, I've talked about a lot. Today. Technical team, how are we doing for time? We good? We're good. Okay.
We're about 14 minutes in.
Okay.
So,
okay, perfect. About 40. You mean 44 minutes in?
Yeah.
Okay, perfect. All right. So, there's a lot more about bonds that I could talk about, but I'm going to skip over a lot of it because bonds are a very boring subject, but they're also necessary because you need to understand what is in your 401k. You need to understand what's in your index fund. You need to understand what's your target date fund. You need to understand those things. Where should you buy a bond? I'm going to end this and then I want to take your questions. So if you have questions for me, you can ask me anything. You can ask me questions about bonds. Ask questions about my life, about what you're going through. You can ask me any questions. Open forum. I'm going to speak for a few minutes. I'm going to give you as much time as you want. So please think of your questions. I'm going to read my questions over here for my friends on Instagram. If you want to ask questions, please go to YouTube and log on and just type in my name or click the button on the top of my Instagram page, and you can go to my YouTube page. And make sure, don't have the red light there. I'm talking to my Instagram friends over there. I love y'all, but make sure when you go to YouTube, don't have the red button. Make sure it's gray. So click the red button and subscribe. I need all of you to do that. And so, where should you buy bonds if you decide you want to buy bonds? I just gave you the reasons why you should buy them. That's if it's a part of a long-term diversified portfolio. I just told you the reasons why you shouldn't buy them. If you're looking to make income right now over a short period of time, they're not good. You can make more in buying dividend-paying stocks than from buying bonds. And again, I'm not giving investment recommendations specifically. I'm talking in general. So again, please don't just go ahead and start buying stocks and selling your bonds. Consult with your financial advisor. Go online and read. Call your CPA. And do some more research. Whenever you hear anybody speak on the internet, don't just take their word for it. Go do your own research. It's very, very important. So where should you buy bonds? Well, there's three places you can buy bonds. If you want to buy bonds, U.S. government bonds, you still decide you want that low interest rate, and you understand that if you don't hold that bond to maturity, you're going to lose money. Again, when I say maturity, if the U.S. government gives you 0.65 or 0.675% and you hold that bond for 10 years, you're going to get your money back. But if you sell the bond before 10 years, you run the risk of the bond going up or going down. And it could go up or go down because of credit risk or because of interest rate risk. There's a lot of other risks we didn't talk about, like inflation risk, duration risk, reinvestment risk, another time. But for now, if you want to buy U.S. Treasury bonds, you don't need to pay commissions to me or anybody else. Go online. There's this place called treasurydirect.gov, treasurydirect.gov, and you can actually set up an account and you can buy U.S. government bonds. They're called Treasury bonds. There's three types of Treasury bonds. One is Treasury bills under 3 months in duration. So they expire in 3 months, within now and 3 months. So they're very, very, very safe. You buy U.S. Treasury. No, they're safe in terms of you get your principal back if you hold it for at least that 3 months. There's U.S. Treasury notes. That's between 3 months and 10 years. And then there's U.S. Treasury bonds. Those are ones up to 30 years in maturity. And so go to treasurydirect.gov. Don't pay anybody a commission. Go buy your bonds on there. What if you don't want to go through all that? You have an online broker, you have Schwab or E-Trade or Vanguard or some other platform, TD Ameritrade, Fidelity. There's a lot of them out there. Go online and you can actually buy individual bonds. You can select the bonds you want. You can do the research. I encourage you to do a lot of research. Make sure the company's making enough profits to pay its debt for at least the next 1 or 2 years, right? It's very, very important. So you don't buy those bonds that are going to go bankrupt. Warren Buffett once said, and most of you know Warren Buffett is my hero because of his philosophy, not just the fact that he's worth almost 100 billion, but his philosophy and the fact that he's resolute and he's stuck with it and it worked. He once said, if you want to become a millionaire, first become a billionaire, then buy an airline. What he was saying was, a lot of airlines over the past 20, 30 years have gone bankrupt. Part of the reason why is because they haven't been able to make enough profits through good and bad times enough to pay their debt. So when you pick a company to buy its bonds, make sure it's capable of paying its debt, whether it's in good times or during a recession. It's a lot more that we can talk about, such as airlines and things like that, but we won't go into detail on those things now. So that's the first place to buy a bond, the U.S. government bond. The second place, that's the second place to buy a bond. Go online and you can just buy an individual bond. The third place, or you could buy it with a financial advisor. That's the second way to buy a bond direct. The first way is U.S. Treasury through treasurydirect.gov, treasurydirect.gov. The second way is through either an online portal or call your financial advisor. Call your AXA advisor's financial advisor, call your Merrill Lynch financial advisor, call your JP Morgan Chase financial advisor. If you want to buy an individual bond, they can actually help you pick bonds. So that's the second way to buy it, through your financial advisor or an online portal. The third way to buy a bond is to buy it inside of a bucket that's called a mutual fund or an exchange traded fund. Again, last week I told you the difference between mutual funds. That's just a collection of a lot of bonds. So I'll give you an example. If you buy a bond of Delta today, what are the chances Delta goes bankrupt? They're not great, but they're not too little. Delta could, any company could go bankrupt, right? Especially an airline with high fixed cost and that whose revenue is short term. So when there's a recession, the revenue goes here and profits go here, but these are the costs. You got to pay those airplane hangars. You got to pay for those airplanes. You got to pay the unions, right? So this is your revenue. So it's easy to go bankrupt, right? For an airline because of high fixed costs and the fact that the revenues are short term and they're volatile. Well, what if you buy the bond of not just Delta, but Delta and American Airlines? There's a lot less chance, right? Because now you have two. What are the chances two American Airlines go bankrupt and you lose your bonds? Slim. What if you have Delta plus American plus United plus Alitalia plus British Airways or the holding company or whatever it's called? What are the chances they all go bankrupt together? Pretty slim. So the third way to buy a bond is to buy it inside of a mutual or an exchange traded fund in a way where you're buying a diversified portfolio. So if you don't want to do the research about the liquidity, if you don't want to do the research about the leverage and all the other ratios and all the other things you should do before you buy a bond, you can just buy a mutual fund that's a collection of a lot of different bonds. And that way, you know, at least you get, even if some of those companies go bankrupt, not all of them are going to go bankrupt. Hopefully not. Hopefully you don't buy oil companies. I'm just kidding. And so that's the second way to, that's the third way to buy a bond, through a mutual fund. And of course, the third way is also not just a mutual fund, also exchange traded funds. The difference between mutual funds, you know, you buy them at the close of business. Exchange traded funds, you can buy them during the day, as the day goes. There's certain risks attached to buying mutual funds as opposed to individual stocks, individual bonds. You know, the one risk of buying an individual bond versus a mutual fund is that you know, you have higher credit risk because, you know, you're only dealing with one company. But the risk when you buy a mutual fund, a collection of bonds and stocks, is that, you know, the bonds are very difficult to trade. You know, they're very, very difficult to trade. Most of the trading, you know, think of a stock of Apple. Apple has one, maybe it has multiple classes, but one class of common shares, right? You know that stock you buy, that share you're buying. Apple could have 10 or 15 or 20 different tranches of bonds, different types of bonds. So if you want to buy a stock of Apple, go online and you buy a stock of Apple. If you want to buy a bond of Apple, you may have to go call your broker who would see like 15 or 20 or 30 different bonds. So usually trading with bonds happens by the phone. It's very slow and it's very cumbersome. But if you buy an exchange traded fund, you're able to sell and buy a bond like on the moment. Sometimes what happens is when you call, a lot of people call an exchange traded fund to sell, they can't sell on time. So there's a disparity between the trading price and the cost of the assets. That's for another topic, but that's for another day. But there's certain risks with buying mutual funds when bond mutual funds or bond exchange traded funds that you don't have with buying individual bonds. And there's certain risks, like I told you, with buying individual bonds versus mutual funds. So I want to take your questions now. Where am I? I'm in LA. Tony McGriff. I'm at home. I'm at home in LA. What was that?
So Lori asks, when should you cash in your bonds? She is 47 and her parents bought them when she was born. So.
Oh, well, I have a lot more questions about those bonds. So Lori is 47 years old. Her parents bought those bonds 47 years ago. Wow, you're a good saver. You've held on to those bonds, Lori. That's amazing. But I need to know a few more things. What type of bonds do you have? You know, there's different types of bonds. Like I said, one of those type of bonds that I didn't mention, you know, I told you about the three categories: corporate bonds, treasury bonds, and also municipal bonds. The duration of the total maturity of the maximum one is 30 years, right? So the longest term bond that we have, there's a 100-year bond in Japan and places like that. We don't usually have those in the US, is 30 years. So there's almost no way that you would have a corporate, municipal, or treasury bond that's 47 years old in the US, unless it's a foreign bond, it's foreign, you know, Japanese treasury bond. But there's certain types of bonds called triple E bond, you know, triple E bonds that you could have for a long 30 years or even longer. So maybe it's that type of bond. In general, Laurie, 47 years would be somewhere around, let's say, early 1970s. And so in the early to mid 1970s, we had a huge recession. And what happened was interest rates we're somewhere in the 15, 16, 17, 18% range. That's where, you know, if you wanted to get a mortgage, you have to pay 12 or 13%. Now you want to get a mortgage, 3, 4, 5%. You're saying, it's too high. You have to pay double digits, 14% sometimes to get a mortgage. Savings accounts were paying, 10, 12%. You know, now you get your savings account, they pay you cents, you know, for every $100, they give you 2 cents. Then they were paying you 10, 12%. And so if you magically happen to have a bond, a fixed rate bond, I don't know how you do, that's 47 years old, that was issued somewhere in the early to mid to late 70s, that bond is probably yielding you teens, 12, 13, 14%. Please hold it. As a matter of fact, let me buy it from you. I'll buy it from you. If you can get me a bond that's 14%, 15%, I'll buy it from you right now. But the chances are that bond, you probably just rolled that bond into other things. So it's not the real bond. You probably just have the bond and then you rolled into some other bonds. My advice to you would be, look at the bond, go to your financial advisor. I don't know enough about it, but I like long-term investments. I believe when you buy an investment, you hold it for long term. 47 years is not a long time to hold an investment. It really depends on the quality of the investment. Is it a good company? Is it a strong company? Is it a company you think that's still going to be around? Is it a company that is giving you an interest rate that makes you happy? There's certain factors you have to look at. Excuse me, when you buy, when you think about whether to buy or sell a bond. So again, please consult your financial advisor. What else do we have, Alex? Do we have any more questions over there?
Yeah, another question.
I still see a lot of my friends on Instagram. I'll tell you something. I'm going to answer one question from Instagram. That's from you, Peach1253. But you should be on YouTube. You know, that way you get to see all the views and, but you should be on YouTube, not Instagram. I'm going to ask you a question. Peach1253 asked, do you need a broker to buy stocks or bonds? The answer is no. You don't need a broker. I explained this last week that you could go online and you can go to Robinhood to buy a stock. You can go to Schwab or E-Trade or TD Ameritrade. I'm not recommending any of them. I'm just mentioning the options. And you could buy it with very low to no commissions. A lot of people are now getting rid of commissions. Robinhood, I think, doesn't even charge you any commissions. A lot of the Schwabs and TD Ameritrade have eliminated commissions on many products, especially funds and even some of the stocks. So you don't need a broker. If you don't need advice and you can do the research yourself, you don't need a broker. If, however, like some people need a physical trainer, somebody who they can work out with, somebody who encourages them, somebody who gets them up at 6 o'clock in the morning. Most of us wouldn't get up at 6 o'clock in the morning to save our lives, unless our physical trainer was calling us, saying get up. That's what a financial advisor is. That's what a broker is. A broker is not somebody who just buys and sells stuff for you. You don't want that. You want a financial advisor who can advise you, who can teach you about what, how the best type of stocks, the best type of bonds. Somebody who can do your insurance, somebody who can do your estate planning, somebody who can help you with education planning for your kids, somebody who can do a financial plan to make sure you have enough money for retirement. Somebody who can help you if you want to buy a new house, if you want to sell a house, somebody who can help you get a good, somebody who can help you. That's when you use a broker. When you have somebody who can help you, not just to buy a stock, you can buy that online. So should we take one more question? We're almost done.
We have a question about 401ks. Should we take that question?
Of course.
All right.
Even though we're going to talk about 401ks, by the way, that's what we're going to do next week. We're going to talk about 401ks. We're going to talk about IRAs. We're going to talk about profit sharing plans, what the differences between retirement accounts are, whether or not you should be participating in retirement accounts, how much you should be putting in, why you should be putting money in, the benefits of retirement accounts. Can you do a retirement account when you're self-employed? Can you do a retirement account when you're an employee? Should you be participating in your company's retirement account? If you're an employer and you have employees, should you do a retirement account for them, for yourself? And how do you maximize your benefit when you have employees, for them and for you, or just for you, if that's what you want? So we're going to be talking about retirement accounts next week. So make sure to hit the subscribe button again before you leave. But in the meantime, what was the question? I'll take that one question.
The question was, my 401k 12-month performance as of yesterday was down almost 10%. I'm starting to be concerned, but if I move the funds now out of their current allocation, when I lose money, How do I avoid any more?
Okay, so if you're concerned about, I understand your concern about stocks going down 10%. But you have to understand that stocks and bonds and other investments carry a risk. By default, you can't make money without taking a risk. Look, if you have money, you earn a paycheck, the easiest way to protect your asset, take that money and put it under your bed. Nothing is going to happen to it, right? The money doesn't grow, but you don't lose it. That's no risk. To make money, you have to take a risk. And when you buy a stock or a bond or some other investment, if it's in your 401k, it's probably stocks, bonds, maybe real estate, maybe emerging markets, maybe frontier markets, maybe Europe. If you have investments in there, you have to understand that they carry risk. And you have to be comfortable with the fact that sometimes you're going to lose money. Most of the time, you're not. Most of the time, you're going to make money. I think in general, it's about 70% of the time stocks go up, 30% or so, they go down. You're going to lose money sometimes, but overall, you're going to make money. If you're not comfortable with opening up your bank statement and seeing 10% down, then maybe stocks are not right for you. Maybe you want to do more bonds, and maybe you want to do bonds where you buy the actual bond and hold it to maturity. Maybe you want to do CDs. Maybe you want to do annuities. There's other things you can buy apart from stocks. But the best and easiest way to make what I call sleep money, that's the money you make while you're asleep. You have all these people working for you because you buy stock of a company that they are working in. They're working every day, going to work 9 to 5, and they're working for you. You get a small piece of their profit. The best way to capitalize on that and make sleep money is through buying stocks. But you have to be able to understand, you have to be able to deal with the volatility. Volatility in stocks going up and down and up and down. Now, in general, over the last 1-2 months or so, it's been a very difficult time. Stocks were up dramatically last year, over 30% last year. And what I would recommend for you to do is to revisit your portfolio, analyze your portfolio, talk to your financial advisor about whether it's still right for you. But in general, do not sell into a declining market. In general, stocks almost always come back. I've never seen a situation in my 30 years, actually my 50 years, actually going all the way back to the Great Depression. I've never seen a situation, this is where I close, right? I've never seen a situation where stocks went down and didn't come back to exceed the prior high. So wherever you are, Laurie, I think who has that question, hang tight, stay strong, stay the course. As long as you have good stocks, make sure you have good stocks or good funds, they will come back. Why? Because buying stocks and bonds is pretty much buying into the American dream. You're buying American companies. And if you expect American companies to be bigger and better and stronger, and our country to be bigger and better and stronger, despite what they say about China, what they say about Japan and all these companies overtaking us, we're still the greatest nation on earth. We're still the most resourceful. We're still the most technologically advanced. So if you believe that American companies in 10 and 20 or 30 years are still going to be the best, are still going to keep growing and being as resourceful and as profitable as they are, which I believe, then hang tight, stick with your stocks. Thank you. I'll speak to you next week. Bye-bye.